Yep.
All right. Thanks, Euan, for doing that podcast with us at Sharp Two. I want to go straight into it. So a couple of days ago, someone in the Sharp Two Discord said, and I'm paraphrasing here, Yuan changed his mind a lot. In his books, for instance, he says the earning edge is gone. And then you showed up in the Discord and answered, I change my mind when the evidence changes. And here it hasn't. This trade has worked and still works. And honestly, I love that answers. First of all, because you own and you stick to very strong belief and intellectual honesty. But because also it raised a question that I almost want to spend the whole hour on. How do you actually decide when the evidence is strong enough to change your mind versus when it's just noise?
Yeah, that's kind of the central problem in trading, isn't it? I think the earnings thing kind of might be a good example there because I didn't remember saying it doesn't work
I
anymore.
don't
What
remember either, but
what what I could well have said somewhere is it hasn't worked very well for the last, I don't know, year, 2 years, whatever. And that definitely can happen. But that doesn't mean the edge has gone away, right? I mean, the edge that we are most confident in statistically is the idea that stocks go up.
yeah,
We've got data for that since stocks existed. So,
yeah,
in the 1600s, over hundreds of countries, different markets, statisticians have done really careful studies. It's indisputable. Over the long run, taking out every survivorship bias and everything, stocks go up. But they don't go up all the time, right? There was a decade where they didn't go up.
yeah,
But it would be really stupid of you to then jump to the conclusion that stocks don't go up again. First, because you've got hundreds of years of evidence they do, which, statistically, you run a t-test or whatever, you're not going to find a decade overwhelms hundreds of years of information. But it also comes back to the fact you've got to have some sort of idea beyond the statistics why something should work.
yeah,
And that's sort of where you should start, is with that idea, because otherwise you're just going to do data mining, right? Because if you test a million things, you're going to find a million things, and they're going to work out of sample as well.
yeah,
And so you'll think, oh, I've done this really carefully. I looked at it in sample, got my hypothesis, tried it out of sample, and it works. I've cross-validated it, blah, blah, blah. But like I said, if you try enough things, you're going to find things that work. So the first thing you have to do is come up with some reason that you think it should work in the first place. So for stocks, that would be when you own a stock, you own a little bit of a business. The purpose of a business is to make money. You've literally got a team of people trying to make you money. That's
yeah,
what they do. So that's why stocks go up. With the volatility premium, it's like, look, you're selling insurance. You're providing a service. It's a risk mitigation for the other person. If you take that risk that they don't want, you get paid for that. Great. So you have to have that reason first. If that reason goes away, then you can just stop. It doesn't matter about the statistics. The hard thing is, if you kind of have a bit of a reason that you sort of believe in, and you have some statistics, and then the effect degrades. So the example of that would be the value premium, with smart beta and factor models for how stocks
yeah,
go up. The original ones were small cap, low beta, and value. The problem is value hasn't actually gone up for like 20 years now. Value has underperformed growth. And to the point now where you're like, really? Was it just a lucky 20-year period we looked at? Is this really all? How much do we believe that story that value, which has less risk than growth, why would you be more compensated for that? So that's one of those the problem with trading, right, and evidence is that nothing is ever a yes or a no.
I
Everyone
agree.
wants it to be a yes or a no. The problem is everything exists on a continuum, right? And if you've got at one level stocks go up, that's a 10. And you've got at 0, you've got some guy's opinion because he read a story once about Japanese candlesticks, that's a 0. Everything else is kind of in the middle, right? So the earnings premium, to me, it's a special case of a volatility risk premium, right? And it's a special case that applies in a lot of situations where you've got a timed event of uncertainty. And you'll have some people betting the stock's going up, some people betting it's going down. Each of those people's buying options. So that has the effect of pushing all the implied vols up. And that's a very plausible reason why that should exist.
Yeah,
But
so
it's noisy.
I was actually about to ask you about this, right? Like I love the sentence when you say you need to understand the reason why, and otherwise you're doing just a data mining exercise. And I think retail traders should spend more time carefully looking for the reason why. What you just said about the earnings, like mechanics, if I can call it that way. Would you say that's the main reason why the trade is here? It's because people fundamentally disagree about the earnings. And as long as you will have disagreement regarding what the stock is supposed to do, you will have volatility. And that's really concentrating around earnings. Is it what you're saying?
I think that's a very plausible reason. And there have been academic studies which show that disagreement of opinion around earnings is an effect. But that's the reason it's not a 10 or a 0. It's like that's a plausible reason, right? Because there's two ways an implied volatility distribution can become more wider, right?
Yeah.
The volatility can get bigger. The first one is everyone thinks volatility is going to get bigger, and so they're buying stratas, and that pushes the vol up. The next one is some people think it's going to go up, some people think it's going to go down. Neither one think it's going to become more volatile, but you've got these two overlapping distributions with different means. That also has the effect of broadening the width of the whole distribution. So I think that's a plausible reason for why. And then you look at the statistics, do the back tests. It does work. It has worked since I've been looking at it, which is like 20 years now. It's very noisy. Like, I think 2 quarters ago was like the worst quarter it's ever had.
Yeah, exactly. It was one of the worst on the short side. But then that's also something we discussed a few times in the Discord. What about the long side?
Right. I'm only thinking about the short side here. The long side its Sharpe ratio is about half as much, but it's a brilliant trade, right? Because it's a systematic long vol strategy. They don't exist.
Yeah.
I would do a long vol strategy which had 0 edge. As long as it didn't have negative edge, I would do it. Because if there's no carry on a long vol strategy, why not have that on, right? It's costing you nothing and it gives you convexity. But, what I was going to say is right before that terrible quarter was one of the best quarters ever. So you've got to keep plowing away at it. And I think that's why it's hard, because it's a risk premium. But most risk premia are kind of buy and hold, set and forget. You can just sort of go away. This one, you have to actually go in every day and bang out 20 of these things. It's very emotionally draining. But I do know, like 20 years ago, no retail did back tests, right? It was much harder to do back tests, but also it wasn't a thing. People didn't do it. They basically guessed.
Yeah.
Now it's at the point where a lot of people do back tests, but then they stop there without thinking of the mechanism for why the thing should work in the first place. But in the options, in the earnings one, most people don't even do a back test, right? Because it's really hard to back test this. It's a huge amount of data. And, you'll be like, oh, some guy back tested it. I've looked at the last 30 earnings of these companies. It's like, dude, I mean,
that's not your sample size is just ridiculous. Forget about it.
Yeah, if when I tested it, I think I used, I don't know, 40,000 observations or
Oh,
something.
wow. Okay.
And I don't, you know the guy Gorin,
Yeah.
right?
Yeah. Yeah.
Yeah, he's been running updated tests on these as we go, and this thing's remarkably consistent. Even allowing for the fact that part of that consistency is its volatility. It definitely has worked, is working.
Yeah. No, I think I agree with what you're saying. Essentially, you have periods where it's not going to be as strong. You're going to have periods where you will see the worst quarter ever recorded, and you will have periods where it's working like a charm. All of these things can be true at the same time. Well, usually they're not true exactly at the same time, but over a long period of time, you will
Right.
definitely see them being right. Still on the earnings trade, I see, and this is really important what you just said right now. Like the edge is about doing a lot of them without necessarily overthinking it. This trade became extremely popular, most likely because of you. And I see so many retail traders either making some variation of it by trying to go ratio spreads, trying to maybe pick and choose the one that they want to take. Eventually, even looking at okay, stock reaction in relationship to past earnings. Do you think there is any merit in this, or this is falling into the category of data mining or potentially looking into the past to try to get something that, by definition, in my opinion, and I don't do that trade, right, is not, you cannot really predict the reaction of people. Otherwise, if you can, it means you have access to the earnings report, and therefore, why would you trade vol on it?
Yeah. Okay. So there's quite a lot in there, right? This is one of the situations where people get implementation and edge mixed up.
Hmm.
They'll be like, there's no edge in this because when you do it, sometimes you'll lose a ton of money and blah 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 blah. All of that is not edge, right? If I show you the statistics, we have to be able to agree there's edge or there isn't. It's just positive expected value, right? It's an average. There's no opinion about that at all. But once you start implementing stuff, I think people make this more difficult for themselves than it has to be because they're always looking for a way to do it perfectly.
Hmm.
And so they'll be like, I'm doing a ratio spread here and a calendar spread here and there and there and there. And it's like, honestly, you're probably just better off doing them all really small, doing as many as you can, and just banging out straddles.
Yeah.
And, don't ever have one big enough that an 8SD move is going to lose you more than X%. And if you're not happy with these risk rate, what that risk means, just don't do it.
Yeah.
Because if you're trying to finesse the thing, you're mixing up edge and hedging and implementation. It does become a problem because then you don't know when it works, why it's working, and which bit's working, and how much is a hedge paying away, and all this kind of stuff. With respect to trying to find good things, this is something I have tried changed my mind about. In volatility trading, I give an example, and this was the original version. So this is 2008. I give an example where I say the implied move is this. If you look over the last 10 earnings, it had never had an implied move that big, therefore we should do it. And you see versions of that thought process people use all the time. They'll be like, I'm not doing this because this one moved a lot last time, or I am doing it because it hasn't moved much. When you go through all the numbers, that is absolutely meaningless.
Yeah.
There's no relationship for any individual stock, how it's done recently and how it will do. There aren't classes of stocks that beat by a lot or miss by a lot or don't. That is a complete waste of time. I wish I'd never written that in the book, but it's the most prevalent thing. No one believes it when I tell them that. They're always like, why would you do Nvidia? Because it, blew out these earnings. It's like, yeah, if you're nervous, you the savvy options trader, if you're scared, everyone's scared.
Yeah,
You get paid to be scared. That's your job here, is do something that frightens you. And if it frightens you, probably a good trade, right? When you're taking a risk premium, it has to be risky. So
exactly.
you have to feel a bit nervous about all these things. The other thing that I know doesn't work anymore, and I can't remember which book I wrote about this in, was the idea that analyst forecast dispersion was predictive. And it's like
Interesting.
if all the analysts have wide ranges of estimates, then there can't really be a surprise because no one knew what to expect in the first place. So that's a good sale. And that was based on very small amount of data. So I was trading this in like 2005 before we even had any data. I was just doing it. But then, like 2008, I found some data and I tested it. And that's when I tested the analyst dispersion thing. And I think I read about it in some paper. And it looked like it worked, but on a really small sample.
Hmm.
And it doesn't work. Um,
Interesting.
I don't know if it ever worked. Well, okay. This is another thing we should talk about, right? Just because something showed up that it worked doesn't mean the edge was ever really there. You
Yeah.
could have just got lucky.
Yeah,
You can.
that's the opposite of what we were saying earlier on. You have the effect that are there for a long time, and you can prove that statistically over decades or centuries. But then you also have those little blip in time and history that are basically kind of like noise. And it's so easy to get caught up in them because you think something is there, but it's just the result of a specific situation we're going through right now as the market participant ourselves.
Yeah, and you're never looking at one thing in the market, right? You're never just looking at earnings. There's always other stuff going on. So maybe one of these effects, you think it's due to one thing, it really isn't. There's another thing in the background which is the driving factor, and it's not the thing you think it is, right? It's that happens a lot in finance. And it really happens badly to people who think they've got some unifying theory of how the market works, like the dealer gamma people. Everything to them is dealer gamma, right? And is it an effect? Yes. Is it the only effect? No. Is it the most important effect? No. But we don't want to get into that. But these people think everything's due to that. And so when it works, they say, ha, see, it works. But it could be working because of something else as well. Like if you only ever consider one thing, you have to attribute everything to it.
Yeah, the classic causation versus correlation, right? Like I think this is also one of the biggest trap that retail traders fall into, and it's interesting because funds like Renaissance Technology, all these guys, they're known to make money by looking into hidden factors, the stuff that are really explaining what's going on and not necessarily being correlated. So you're a physicist by training, right? So is this where this comes from? You're confronted saying I was wrong, because you said that multiple times right now in the conversation, or at least I have changed my mind. Um, because most traders I know have the opposite instinct. They tend to double down on their priors. Do you think this is something you can train? Do you think this is something that you have to fundamentally be comfortable with as a trader, and how retail traders can, or solo traders, because I start to really dislike that term retail traders, but how solo traders who do not have risk managers next to them, quant desk, probably don't read as many research papers. How important is it for them to update their priors ultimately?
I think all the good traders I've known, and I don't consider myself a good trader. I've been in the game, I can do it, but I'm not a great, right? All the good ones I've known are very open to criticism of their beliefs. And Aaron Brown, who was the AQR risk manager, he said all the good traders use words like on the other hand or and maybe, whereas bad traders use words like and also and furthermore. They're always looking for extra evidence of why they're right, whereas the good traders are looking for reasons they could be wrong. And now that you learn that like anything else. Someone tells you that's a problem, and then you start training yourself to try and think that way. So it's not magic, and it's not anything that I was sort of, I don't know, born with. You don't learn that in physics. To a certain really high level, you do, right? If you're Einstein, you do. When you're an average garden variety physics PhD, you don't think about stuff like that. You're solving differential equations and stuff. You don't have time to think about deep thoughts. But it is something you should really, it's the most important thing in trading, to always ask yourself, why am I wrong here? What is it in the world that would have to happen for me to be proven wrong and I get out? Because that's the important thing, right? It's like you want to know when you're wrong. And a lot of people are like, they don't want to be told they're wrong. But in trading, if you're wrong, you want to find out really quickly so you can stop being wrong, because being wrong will cost you money. So it's that kind of intellectual humbleness is really important. And I think you can learn that.
100%. I think if you're not able to assess your prior belief or why you did something, but also importantly, you need to record all the data that led you to make that decision. And then you need to, I write that series, which became quite popular, the Trade Anatomy series, where I've written about a signal 2 weeks ago. Now it's time to debrief the trade. You learn so much by making sure that the thesis you had written at the first place is either actually became true, or if it didn't, and yet you make money, you understood why, and then you understand where you got lucky throughout the process. Because especially in the variance risk premium game, right? Like in the option game, there's so many occasions where you can end up on the right side of the coin, but not necessarily for the right reasons. If you do not sit down to review what happened, I think on the long run, you're gonna drift away from that intellectual humbleness and honesty, and that's a recipe for disaster, I think, at some point. But anyway, so we've talked a long time about earnings. Let's talk about the edges themselves. You talk a lot about small edges that compound, and VRP is obviously number one in most people's list. But if you have to rank the others, earning premium, skew premium, because you talked about that in risk reversals, do you have some sort of hierarchy? Like, how would you rank one against the other? And most importantly, because it's about changing our mind, that conversation, has that ranking changed over time?
Okay, so that the micro alphas thing I was quite proud of that word, because that's the thing at Hull that we do. We've got a stock timing model, and it's got like 30 different things in it, and they're all little signals. So before I came up with that term, and I was very proud of it, because before that we were using all sorts of different things. But anyway, it's really the concept that you can have lots and lots of small things that add up to something big, right? And I think a lot of outsiders think that the reason, I don't know, Renaissance made all that money is because they found some signal that's like 60% of the time is accurate. But they haven't. And the reason they haven't isn't because those signals are hard to find. The reason is that if they existed, they'd be too easy to find, and everyone would find them. The reason pros can make money isn't because they find better signals. It's because they can find lots and lots of small signals and put them together in a way they can manage. Whereas your solo trader, I've got no problem calling them retail, by the way, because retail is just the opposite of institutional.
Yeah.
I know plenty of retail traders who are good traders, and I know plenty of institutional traders who are idiots. So I don't think it's anyway. That's very difficult for a solo retail trader to do, is to manage lots and lots and lots of those small things. And it's actually one of the things I think your platform's good for, is that basically you're doing a lot of that background data collection and cleaning and analysis, and there's a lot of work in that, right? Like I think most of the stuff you do is based on synthetic variance swaps. There's no magic about pricing one of those.
No.
Like I can write the equations down on a bit of paper.
You can ask
Actually
Claude to do
doing
it.
it,
Claude is amazing at doing it now.
pulling out all that data that's the hard bit.
That's the hard part.
So that kind of micro alpha it's the management of it that's the difficult bit. So anyway, in the vol space, okay, so this is starting with what you said about the VRP, right? The only way a vol trade makes money is if the implied vol is different from the subsequent realized vol. That's it. It's the only way. The problem is we don't know what the subsequent realized vol is going to be, right? So in 2005, if you had a Garch 1-1 model for forecasting volatility, you were ahead of the world. That was all you needed back then, and that would have been enough. So you're literally using historical volatility to forecast volatility, and that gives you an estimate of VRP. And that's what I spent a lot of time in volatility trading doing, because again, that was 2008. And in 2008, that was a worthwhile thing to do. But the markets now pretty much price in all of that time series information. Like you can have the best time series forecast out there, and it probably isn't going to help you a lot. To the point where now it used to be you had to do your best forecast possible. Now it's like, you know what, as long as you're in the ballpark, you should be good. It's not so much whether you think the VRP is 5 vols or 4 or 6. It's whether it's 5 vols and usually it's 3.
Yeah.
So, it's not so much the number you get, it's the context. How big is that number relative to where it usually is? So the concept of volatility cones, that idea, really important. The actual number you get for the VRP, you may as well just measure the historical 30-day volatility or whatever and just say, that's my forecast. Yeah. Because all that time series stuff, you still have people saying, well, I've got a time series model for forecasting 0 DTE, blah, 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 blah. And it's like, okay, but the chances of you using that to out-forecast the implied vol is really small. So that used to be by far the most important thing. And it's the thing you're trying to predict, but the current number of it isn't a great predictor anymore. So I would say the things that I think are the most important in this order, roughly, I would say the term structure, then the skew, then volatility of volatility.
Yeah.
And they all predict whether a trade's going to make money or not. Term structure on its own is probably enough to do it, I think. Although I don't like saying things like that because I don't only use that, so maybe it isn't enough.
Of course, it's always like this. I mean, in the platform we use quite a few factors, and it's quite correlated with what you just said. Term structure is an important one. Vol of vol, I think, in our last conversation, is really the one people should be spending more time on. We have had an example again in the market these days where you see VIX rising, probably because there's CPI tomorrow and Nvidia is not too far away, but it takes 3-4 points in 3-4 hours, and I see some people getting really uneasy in the Discord, and I'm like, Yeah, but this is expected. Your vol is really high right now. The market is overall working on eggshells. You should expect VIX to go up by quite a margin. And it doesn't mean when the trade is there that, oh my God, maybe, yeah, of course it can go to 30, but then you need to use the other elements that put things in context and in the regime, like the term structure, what you just said, and then say, well, okay, it's at 2021 right now. Maybe it's time to get in. And as a follow up to that question, ultimately, one pattern we see is that hierarchy ultimately is not really stable. In high vol of vol regime, the skew premiums, for instance, shrinks compared to the VRP. Does that match overall what you see? And if you had to think in regime, how would you classify them in a broad regime classification where things are completely crazy, things are normal, and things are mean reverting?
Yeah. So when I was just thinking when I said skew was more important than volatility of volatility, and then you went on and kind of said the opposite. One of the numbers I track all the time, right, is the Z-score of the ratio of the VIX to VVIX.
Okay.
You know, because when you see the VIX low relative to VVIX, and when I say things like that, and I think you mean this as well, it's always a Z-score, right? It's
Always
always putting it in context. There's no such thing as a number on its own.
100%.
So if you just look at that Z-score, just do a rolling 6-month Z-score or something, you definitely see, when the VIX is looking stretched one way or the other.
Yeah.
And even on the long side, this will definitely tell you, this looks cheap. It's just relative to how much things are moving, it's too cheap. So that is a useful number. In terms of regimes, yes, skew is definitely less important at high vol. And that's largely, I think, because it's always been that way. It's like, first, people aren't reaching for insurance as much at high vol because they're kind of sitting on their hands. They don't want to buy insurance if they didn't already have it. The people who did have it are selling it.
Yeah.
And secondly, if the VIX is 50, you get a situation where almost all of the strikes are much more similar to each other.
Yeah.
If the VIX is 10, there's a big difference between the, 90% strike and the 91% strike. But if the VIX is 50, that difference is much smaller. So the skew definitely, if you measure it sensibly, definitely flattens out. I think one of the problems people get with regimes is they don't think enough about the things that are predictive in a normal market, like term structure, right? In a normal market, the term structure slopes down and it's got a certain convexity, and you can measure those things and see where they are in relationship to each other and blah, blah, blah. People try and do the same thing in crazy markets where the term structure is inverted. So if it was a future, you'd say backwardation. That is really not, it doesn't work that way. And the problem is, in a normal market, everything's normal. That's what it means. And normal markets are all the same. It just basically means not much is happening. So when not much is happening, not much is the same in every period. Whereas crazy markets, it's always something different. It might be, credit crisis of 2008. It might be Asia in the late 90s. It might be COVID. It might be Volmageddon. All of these things are different. And they all throw the term structure into backwardation. But looking for consistent patterns across those events is really dangerous.
Yeah.
Because they're not the same thing. And you can't just look and say, oh, vol relaxes on this time period because my Garch model says so. Because that relaxation is going to be driven by the underlying cause. In COVID, that vol didn't relax for like a year. Whereas, when was it? Was it August the 5th of 2024? That massive move we had overnight, over the weekend.
Yep.
That
August
relaxed
2024.
back in 2 days
Yeah.
because that was a liquidation event. So you look at the numbers, hey, it's the same as at the start of COVID, but it's totally different. So I don't think you can just measure regimes by numbers. I think you have to remember when those numbers are reflective of a different underlying regime. So I think there are certain things you can do in quiet periods that you can always do. And I think you can analyze the crap out of term structures and convexities and all that stuff. In high vol periods, I think that's really dangerous.
Yeah.
And I also think it's dangerous to look for any rules in high vol periods because there just aren't that many. So you're like, oh, when the slope gets to plus 110, that works. But if it's plus 115, it's something different. It's like, dude, you've got 5 data points for each of these things.
That's what I was about to say. Well, first of all, it's not so often that the markets are getting completely crazy, so you can't really take that as an example. And then one has to remember that it's human being on the other side of the market. And by definition, you can't really modelize their behavior, and what they will think is a crazy situation that requires overaging versus what is a normal situation now, and then is going to trigger de-escalation. I think it leads naturally towards vol events and vol spikes overall. I know we have had like quite a few debate again in the Discord recently around risk management, delta hedging. I want to start about the need for wings and edge. Is this something where you have changed your mind over time? And is there a way where you could find some regime where it's justified to maybe drop the wings?
I think I've changed my emphasis over time on this one because when I started, I was working at a market making firm, and your hedging is far, far more active. And you're hedging with the underlying because you've got a whole smeared out position of strikes all over the place. It's not a matter of you're moving and you're staying within your strikes or whatever. That doesn't exist, right? Everything's a mush. Whereas if you're doing sort of positional trading, whether it's institutional or on your own, it's much more likely you've got 2 strikes, right?
Yeah.
You've got you put on the 20 delta strangle or whatever. So in that regard, how does this go? Delta hedging is really important, right? Because we don't have an edge in delta, so you don't want to be exposed to delta. That's the reason you start with a strangle. Because really the premium with a strangle, the good stuff, is on the put.
Yeah.
So the edge is by selling the 20 delta put. So what you could do is sell that and delta hedge it. You'll be delta neutral and you've got the edge. The problem is you don't have Vega exposure that's anywhere constant over a range of the underlying.
Yeah.
If you move up, vol's going to get crushed. Well done. You don't have any Vega left. You whatever. So that's why we do the 20 delta call as our initial delta hedge. It's because we've now got Vega exposure over a wide range and we're delta neutral. So it's that you've got to remember that you not only do you not want delta, but you want to be exposed to Vega. And you want a certain Vega profile. So when you move, and let's say you go down, so your at the money is now at your short strike, what you could do is then start delta hedging it with stock. But that doesn't solve your bigger problem in that you don't have the position you want anymore because you didn't want the at the money option. If you did, you would have done it in the first place. You wanted the 20 delta option. So the best way to mitigate your delta risk is to re-roll those strikes. So because options are expensive to trade, I think non-institutional people, whatever you want to call them, have to do those delta adjustments less frequently. And I think it's better if they do them by rolling the options. And I think a lot of people don't like doing that, right? Because they'll be like, oh, I've got to defend this strike or something. I don't even know what the hell that means. It's like you're treating that option as like a precious thing that you've got to keep. I mean, you don't have to have the at the money option. You don't want that. You've always got to have that idea of what is the position you want, what is the position you've got.
Yeah.
If they're different, make that one into that one.
Yeah.
And people get very attached. They're like, I've got to defend this strike. I've got to repair this position or whatever. It's like, you don't have to do any of that. Just get out of that, get into the new one, keep on moving on.
When do you decide to? We've had crazy example this year. Silver, oil, Bitcoin to a certain extent. When do you decide that it's time to move on anyway, versus rolling down the option chain and recenter so that you get again delta neutral and exposed to Vega and the position and the risk profile you wanted at the first place?
Well, that goes to you. However you got into that position, right? You've made a forecast of what VRP will be, and I've said it's not just based on time series. It's based on, in the case of your model, what do you use, a random forest or some XG goose tree or something?
Yeah.
You've got that forecast. So all the time, do I want to be short vol here or not? So as long as that hasn't changed, you just keep rolling the strikes around. You should never get forced out of a position because you've lost money. I mean, that sucks, but you've already lost the money. That's over. The question is now, do you want to be short vol in silver? And if you do, roll the strikes down so you're short vol again. It shouldn't ever be. You shouldn't have your trading decision based on the money you've made or that you've lost. It's like there's no such thing as unrealized losses, right? They're losses. That's what they are. Calling them unrealized losses is like, well, I haven't locked them in yet. You might not have, but your broker has. And if you suddenly get too many of them, they're going to liquidate all your positions. They're real numbers, right? So I guess that's the first thing. The second thing I would say is those three things you talked about, like silver, nat gas, what was the other one? Bitcoin, right? Yeah. If you were short options in those, you would have lost money. That's the first thing you've got to realize. It's not that you did something wrong. You took a bet and you lost the bet. It's like, if you bet on, I don't know, Brazil to win the World Cup and Germany wins, you're going to lose money. And you're losing money not because you did something stupid, but you did something wrong. So I think people want to sort of think, oh, if I'd done this better, if I'd done that better, I would have. It's like, I mean, like I said, I'm not the greatest vol trader in the world, but I don't suck either. All of those instances, I was short vol, and in every single one, I lost money. I don't see how you could be short vol and not lose money.
Yeah.
And that's fine. You've got sometimes the house has to win. Yeah. I mean, sorry, the customer.
The customer. Yeah, exactly. You're supposed to act as the house, have a lot of small uncorrelated bet, or if you stay into the insurance realm, once in a while you're gonna have that catastrophic claim to settle, right? Like there's no way around it. I mean, I got punished in silver this year. I got punished in GME a few years ago. It happens. Is it going to stop me from keep selling vol? Absolutely not. But then the conversation, and it's interesting that you brought it towards delta hedging, but my way of staying in business at the end of the day is to always buy some wings in the back, because early in my career, there was something called Fukushima, where I came to the desk in the morning and then everything was up to when, I mean, thank God we had edges, and then I learned my lesson that day. Would you I know that it's a bit counterintuitive for retail traders that, again, as you just said, love to defend position, love to stay active. Would you say it's important to always have those wings in the back, and probably more important than delta hedging, trying to find some sort of mechanism where you can stay in a position?
Yeah. I think having a hedging option position somewhere is really important. Like, I don't think you can be. I'm going to come back to the individual position bit, but I think having those long dated wings is super important. And this is something that some people seem to have not read this part of the book. But one of the things I say is the most important risk management tool is net long options. Because if you're net long options and the world goes to crap, it doesn't even really matter what those options are, because they're going to help. Can you always be that? No. But that's sort of the thing that you kind of want to be, right? And also, if you're buying long-dated options, there's very little variance premium in like a 6-month S&P option. Sometimes people don't want to do it because they're like, oh, but this strangle, I'm selling that front month, the zero DTE strangle for like $6, and I just had to pay $200 for my hedge. That's ridiculous. But it's theta every day, and its variance premium is minimal. So you've got to prorate that over the next 180 days or whatever. I think it's really important to have those options. I don't think you can do that for every single individual position you have, and I don't think you need to. I think because you're not trying to hedge small things that you don't like happening to you. You're trying to hedge. You know what? How much did the VIX go up today? 3 points or something?
Yeah, 4 points, 17 to roughly 21 at some point.
I mean, hedging that, that's not the thing you have to worry about hedging. If you're short vol and that happens, you should lose money, right? The thing you have to hedge against is if the S&P drops 8%. That's the sort of thing. It's not like oh, this is bad. S&P went down today, I lost money. That's terrible. It made me sad. No, it's like if there's a crash, that's when you want to hedge. And if there's a crash, hedging everything with S&P is probably fine, right? I mean, if you're trading commodities, well, that's a bit different. If you're trading crypto, bit different. But if you're trading stock options, you don't have to hedge every single stock option with itself. You can just buy S&P or IWM or the Qs or whatever. But I would definitely encourage people to do that.
And then comes the reverse, because every time I start telling people you need to buy those wings, you need to hedge, they do what you just said. They're like, okay, well, do I need to also buy wings in Bitcoin? Do I need to also buy wings in silver? And I mean, to a certain extent, if you want broader hedging, coverage, then why not? But the fine line is, and I'm interested in your view here, and same if you have changed over time. When is hedging too much hedging? Where do you draw the line?
Yeah, because like if you're trading earnings, say, and you're always doing an iron butterfly, so you're always buying the wings, you're not going to make any money, because you can't make money from a risk premium if you're not taking the risk. So what you should do, and it doesn't have to be perfect, right? This is one of the other things that drives me nuts, is you say something and people go, well, I don't know that number exactly. It's like, well, of course you don't know that number. You don't know anything exactly, right? But it's better to do a rough estimate than no estimate. Just because you can't be perfect doesn't mean you can give up. But anyway, you should have an idea of the variance premium that you're collecting. So given that, you should know how much money you can throw away on these hedges, right? So if you're selling vol in the short dates in the S&P at 20, you should kind of know what's that variance premium there. What do you think it is? Is it 4 points? Maybe. Is it 3? 5? Sure. It's not 10 and it's not 0, right? You can put a range on where that is. So that gives you your expected profit from the short position. Now, how much can you pay away for your hedges? And it's okay at this point because these hedges are so far away, you can almost think of them as just throwing away the premium. How much premium can you throw away and still make money because of your expected P&L? That's what I would do.
Yeah, that's exactly how I view it. I often talk about two business units that are completely independent, but not 100% independent. Your revenue generative side of the house is selling vol. You have to reinvest some of that premium into buying hedges routinely. And then ideally, and I don't know where you stand there, but yeah, ideally build convexity because I'm getting more and more convinced, but maybe that's just because we've had like some crazy move the last 18 months, but I'm getting more and more convinced that on the retail side, what's really going to be life changing for you potentially, right, is having those lottery tickets here and there, but they're still expensive, and you still need
Oh,
to
yeah.
make sure you can finance them, and there's no way around it. If you want to be able to finance them, the revenue side of the book, so the short side of the book, has to be effective enough so that you're basically buying a 20 5 delta put for nothing because it's been financed with something else. Have you ever in your career, because you don't talk too much about the long side, you're more known for the short side. Is this an idea you've toyed with over the years? Where do you stand there with convexity and overall lottery tickets, which is more Taleb kind of idea?
Um, yeah, I don't want to get into Taleb's arguments in particular, but you'll sometimes hear people like say, "Oh, I'll buy options when they're cheap." Okay, you got to get over that. They're never cheap, right? They're never good. Why on earth would someone sell you convexity for below its value? I will buy all the free convexity I can. So if it's ever close to cheap, I will buy it. The problem is that convexity stuff is really expensive. So you've got to realize that stuff you're buying is the most overpriced options there are. So the only reason, like you said, that you buy them is because you've sold other stuff that you expect to cover it in carry terms. So the other reason that they say sometimes is, oh, it helps you with your logarithmic growth, right? It can increase the logarithmic growth of your portfolio because you don't have such big drawdowns. If you go through the math and you do the simulations and think about the Kelly criterion, which is where all that comes from, that is never going to be true unless you're buying those options below fair value. Because, I mean, think of it this way, right? It's like if that's true, what those people say, then it shouldn't matter what price they pay because they've never mentioned if you buy it below this value. Okay, well, if I pay 500 vol for it, is it going to improve my growth? Well, of course not, right? So it has to be below a certain number. And whenever I've looked at it, it's never been below that number. So in terms of just having long wings as a way of, I don't know, making money in any way, I've never seen it. I've never seen value there. I'm not against it philosophically. I'm just against it statistically because it just never seems to. How do I put this? You can always find short vol stuff based on statistics, right? Because, like I said, short vol pays off in normal states of the world. You've got a ton of situations where normal is the state of the world. Long vol pays off in idiosyncratic situations. So there's no statistical method you're going to use that's going to, somehow forecast an earthquake or Trump doing something crazy at the weekend. That's the problem with long vol. You're not going to be able to find. Does long vol make money? Sure, sometimes, but you're not going to be able to find those systematically because it's not a systematic thing.
Yeah.
So, I mean, do I buy wings? Well, sure, but I hate it. But you have to. So
Yeah.
I don't expect to make money from it. But one of the great things is if you don't get hammered when other people are getting hammered, it gives you a lot of freedom to do stuff.
Yeah. And I
And if
actually
you're
find that this is where you make this is something people often overlook, but just the ability to maneuver in a market that's getting crazy is often the difference between a great year and an amazing year. Like if the hedges were there and therefore you still have margin, you still have buying power to do stuff. Just let's just put vol on the side for 1 second, but just buying S&P in March 2020 because you still have the ability in your account to do that. That's a fantastic trade. Just do it. But you need to be in a position where you will be able to do that stuff. So I'm less a proponent of trying to predict these things rather than being able to act when these things happen.
Yeah, and that's why market makers always bought teenies. They knew they were overpriced, but it's business insurance. So when the world goes to crap, the only thing a market maker has on their side is the ability to make markets, right? If you can't make a market because you're so hamstrung with margin or something, there's no way you can make money. So they have to buy these teenies so they pay off in these states of the world, even though they know they're throwing money away. And that's exactly what we're doing as vol sellers, by the way. Market making is selling vol because market making is intrinsically a short gamma operation.
Yeah.
It works if things are moving in a range. If whatever you're making a market in is trending, you get screwed. So you're always short vol, even if you're not trading vol. The structure of your strategy is short vol. And so they are always buying those wings. And that's what we're doing. We're short vol systematically because we're selling options. Hence, we have to buy the wings as well, because that's the business insurance for what we're doing.
Yeah.
And yeah, it sucks. Well, that's one of the other things I think a lot of people, though, make a mistake. When the VIX goes to 60, they're like, what do I do? What do I do? Because I said earlier, it's not going to be the same as when it went to 60 last time. And people's follow-up is, but I have to have something. What do I do? It's like, you don't have to do anything. I mean, you go to the beach. I don't know, take the dog for a walk. Just because something's happening doesn't mean you have to participate. And hopefully you've set up your book in a way that you haven't lost a ton of money. You made some money maybe. Okay, rebalance your book, move your strikes around. You don't have to do anything different. You don't have to make some crazy play where you start selling VIX futures or whatever if that's not your game. You don't have to do something. It's like when GameStop went crazy. They're like, how do you trade meme stocks? I'm like, well, I don't know. You don't have to trade meme stocks. You can
Sit
you
around.
can trade. You can trade Johnson and Johnson. It doesn't matter. You don't have to trade something just because it's in the news, right?
So interesting. So talking about this, have you because the zero DTs are in the news every single day. Have you ever
Yeah.
changed your mind on zero DTs?
Uh, I don't know. I don't know because I'm not sure what I said in the first place about
So
zero
I
DTEs.
remember a few years ago an interview where you used to say you love them, but that was a long time ago, right? That was at least 4 years ago. And then I get a sense of a much higher skepticism about them these days.
Okay, so I do love them and I still love them, but that's kind of like I love them. I don't recommend most people trade them. And by the way, I love them, but that's because I'll admit, like I'm an addict and they give you something to do and it's a high. If you told me I could never trade them again, I wouldn't care that much because I don't make that much money from them. And you can't because the variance premium in dollar terms is really low. right? So sure, you've got like 5 vol variance premium, but go through the numbers. That actually is a really small edge. And the costs relative to the size of that edge are huge.
Yeah.
So I think most people shouldn't trade them, probably including me, because also the other thing is they get out of hand so quickly that if you have to think, what do I do, or what does this number mean, you're screwed. You can't do that. You have to absolutely know everything about how options work all the time, when vol moves, when the spot moves, everything. And the theta, you can see it actually in real time. You can see the options decay. So I think they're a bad product in terms of making money for most people, just because of the costs. So I think probably most people shouldn't trade them. I like them, but I probably shouldn't trade them either.
You're calling them the cigarettes of the retail traders?
Yeah, I was going to say it's more like drugs, like hard drugs. You're like, hey, I can handle it. I'm not getting addicted, but you probably shouldn't. It's not good for your health. So, I mean,
Fair enough.
I saw today it's like 62% now
It's
is zero
insane.
DTEs.
It's insane.
I think it's really dangerous, actually, because we don't really know who's doing them to the degree that, like the CBOE, they don't care, right? The exchanges don't care. All they want is volume, and again, volume. So I'm kind of like concerned. We should probably do a bit more work finding out who is trading these things. Otherwise, we could have really bad systemic risk popping up somewhere.
So here is a place where you've just changed your mind, because I remember again maybe a year ago we had that conversation, and I was on the side. I think it was right after August 2024. Actually, I was on the side of, hey, like I can see a world where at some point zero DTs can bring the market down. And at that time, you were thinking, well, that's unlikely because, you have hedging mechanism in place. They, at some point, decay by the end of the day. But again, like it goes into the line of what I've observed in conversation with you and stuff I read about you, or conversation in the Discord. It seems really like your mood about them has been changing.
No, not for that reason. I don't think they'll cause the stock market to crash, because generally the people who are dynamically hedging, market makers, are long. So if anything, that's a safety break on the market, and most of them expire to cash at the end of the day. So I'm not worried about them causing the market to crash. I'm sort of worried more about them causing wider sociological problems. It's like, okay, sports gambling, right? I mean, I gamble on sports. I've got no problem if you can gamble on sports and afford to lose all the money you gamble. That's fun. It's fine. Who cares? Good, nice, fun, clean entertainment. The problem is a lot of people don't. A lot of people bet too much on them, right? And if you look in the US, the states that introduce sports gambling almost immediately see an uptick in divorces, bankruptcies, domestic abuse. Clearly, these are in some way a bad thing. That's the thing I'm worried about. It's that sort of societal externality, because we don't know who's buying these things. If they're just people, I don't know, tech bros who are losing money, who cares? But if it's like people who are gambling their mortgage,
Yeah.
this could be a problem. But I don't think it's going to destabilize the stock market. I think it's a broader problem than that. It's not a financial problem.
Yeah, interesting.
But I said this at a CBOE conference, and I don't think I'm going to get invited back, because I said they really need to go out and talk to their customers, because they're doing a lot of statistics on retail this, retail that. I'm like, I don't care about the stats. I want to know who these people are. Like, go and interview people. Because you know how
I think you can just. I think you open Reddit, right? You open Reddit and you know who those people are.
Well, that's a subsample. And I
You
mean,
think?
frankly, if everyone on Reddit lost all their money, I'd be happy as hell because that's full of idiots and annoying people. But you know how Kalshi recently got regulated in the US?
And yeah, they can do
They
margin trading or something like that now.
they went out of their way to be regulated as a financial exchange and not a bookmaker because financial exchanges have less regulation than bookmakers do. That is crazy. You know, like if you look at an ad for FanDuel or whatever, the amount of disclaimers they need to have on the screen is huge. The CBOE doesn't need to put up anything.
Yeah.
It's insane that we're regulating people gambling on soccer games more than we are people gambling on zero DTE options. It's just nuts. So yeah, I'm probably not going to be at the risk management conference this year because they don't like people saying that on stage at their events.
Yeah, understandably so. Okay, so here is another one that you're very well known for, and I'm very curious to see if you've changed your mind around it. Kelly criteria. Do you still apply it? Do you still think people should apply it? It's a widespread ideas. Everybody, I think, understand the concept, but a lot of people are uneasy about it. Like, what's your view about it 20 years after volatility trading? Because it was in the first edition of the book, right? If I remember correctly. I read the 2013, so I don't know about the 2008. But yeah, where do you stand there now?
It was. I would take issue with the fact everyone knows about it and understand. I think most people who've heard of it get it completely wrong. Because most of the time they basically use that form of it that applies to binary bets. It's, edge over odds, P minus Q. And it's not just a bad approximation, it's totally wrong. For anything with a continuous outcome, it's just wrong. So if you're applying the wrong equation and you say it doesn't work, that's on you. What the Kelly criterion is it's the answer to the question, how do I get the fastest logarithmic growth? That's it. And that is the exact answer to that exact question. The problem is that it probably isn't the question you really want answered. But that's a different issue. Like Aaron Brown again said, the Kelly criterion is the optimal answer to a question you don't have. And in that regard, I still totally believe it. I use it a bit because when I'm doing a trade that I've never done before, a strategy I've never done before, I like to calculate what the Kelly ratio is just to make sure I'm trading way under it. Because even if you're not going to trade using it, it exists. And if you trade above it, you're going to get screwed. So to me, it's kind of like a speed limit. And usually I'm miles under it. So I think it is important in that regard, but you've got to use the right version of it. And also the thing that drives me absolutely nuts is when people say, but we don't know exactly what the parameters are, as though that's some sort of gotcha. You don't know what the parameters are for anything, right? If you've got enough of a knowledge base to know there's edge, you can also know what goes into the Kelly criterion. It's the same thing. So yeah, you don't know, but you don't know anything for certain. And also I wrote a paper on it. Hundreds of people have written papers on what to do with the Kelly criterion if you don't know what the parameters are. So that parameter uncertainty, it's been asked and answered. But it's one of those things, it's like when people say, oh, it's economics 101, like that's some sort of gotcha. Well, the thing is, dude, that's the first course you do. there's a whole bunch of other things above 101. Maybe you should read them as well. And that's like the Kelly criterion. People come up with these really strong opinions on it when they don't know anything about it. So yeah, you've got to understand how it works for different distributions. They don't need to be normal, any distribution. And you've got to understand what it means for different parameter uncertainties and stuff. And once you've done that, it's a useful thing to know. It's a framework. Like, I don't calculate the Kelly ratio and then size all my trades to that. But
I think that's the important distinction here that people got wrong. I love the idea or the analogy with the speed limit. At the end of the day, this is really something that helps you driving sizing more than optimal bet to drive the growth of your account.
Yeah, it's like if you're trying to optimize something, then you shouldn't try and optimize anything, right? Because once you're optimizing, you're doing it towards a certain target function. And your utility is always much more multidimensional than that. You don't just care about one thing, which Kelly says you do. And no one really does. So, but I think it's realistic. If I said to you, if you have more edge, will you trade bigger? You'd be like, sure. And if I say, if there's more risk, will you trade smaller? Sure.
Yeah.
If there's a bigger skew, would you trade smaller? Sure. Kelly's telling you all of these things. So the process that it's saying makes total sense. I mean, if you calculate the Kelly ratio and you trade exactly what that number is, yeah, that's really dumb. I don't know what you want me to say. I'm not saying that that's a good idea, but the concepts behind it are really useful. And even if you don't like it, it still exists. It's like saying, I don't like evolution, so I'm not going to believe in it. Well, evolution doesn't care if you like it or not. It still exists.
It's still going to be there anyway. Okay, so that's it's interesting because I never really talked with you about this before, so I wasn't exactly sure where your stand was, and I actually was on the camp of people thinking you were actually trading it, not really using it as some sort of speed limit. I don't do it, but it's the same idea. I use volatility and vol of vol to size the bet and then try to stay way underneath it anyway, because it's not worth it. But I think having a speed limit is a
Well, I think we had this conversation one time when we were talking about how you'd size a volatility trade. And I said something like, I use the Kelly criterion to this, and this. And obviously, like to me, I use it in a way there. If you're assuming that you want to trade bigger with edge and smaller with volatility, you can work through the math and what that means with the VRP. And it will give you a sort of number so you can kind of come up with the relative size for different trades. I mean, that's all I'm doing. I'm not trading I use it in that kind of sense. Yeah. But yeah, and actually for some things it's much better than others. Like if you're a blackjack player, if you don't use it, you're not going to make any money.
Yeah.
If you're a sports bettor, particularly where you're capacity constrained, you should be using it there as well. Like Andrew Mack, he uses it like for sports gambling. I mean, sports gamblers, they use it. It definitely makes sense. For finance, it's not.
Yeah.
It's not quite as useful.
I get it. So here is when the last conversation we had, you slammed me on the 25% exit rule. Is this something you could ever change your mind on?
No. Okay, so it depends on the reason you've done it, right? Because I know you are doing things, and everyone should, based on their audience, right? So you're trying to give people a thing that they can implement and manage. And that's really important. It's really important to have something, a process that you can keep up with. Even if it's not the optimal process, it's better to have something that's okay, that you can do, than something optimal that you can't. So I understand why you've come up with this 25% number, but I don't like it because I think it's sort of, I don't think the price you got in at should have any bearing to the price you get out at. I think it's you've got to keep doing the edge.
Yeah.
If there's edge, you stay in. If there's not edge, you get out. 25%, whatever. But there's much more work involved in that. And I don't know who your customers are. I don't know, are they people who have full-time jobs? Are they full-time traders? I have no idea. But if you're doing this and you need a simple rule, then I can kind of see where you're coming from.
Yeah, and the other benefit for me in doing this is it forces the conversation of reevaluating whether or not you still have hedge in the position or not. Because more often than not, I see people falling in love with their position, and what was a volatility trade at first becomes a theta trade. It's like, I can still collect data in that position, so let me stay in it. But S&P was a great example this week, for instance. When you sold S&P the week before, you collected Vega because it went down. You're much closer to where realize is these days. You should probably get out because the edge is not as strong anymore. But most people, I know way too many people that would say, well, I still have X amount of data that falls on my account every single day, so I'm going to keep the position.
Yeah, honestly, theta, the idea of it has probably cost more people money than any other thing in the options world. It would be better if people didn't know about it. Like, everyone's like, oh, I'm collecting theta, so I must be making money. You collect theta even if you're totally wrong.
Yeah.
Right? I mean, theta, all options decay every day. That's not news.
Yeah.
The question is, do they decay by more than you lose on the gamma part of it? Like, gamma equals theta. That's basically the Black-Scholes equation.
Yeah.
So the only time you make money is if the implied vol is too high. If that's the case, the amount you make through theta is greater than the amount you lose through gamma. But if it's not the case, then sure, you'll be collecting theta, just not enough. So, yeah, the idea of hanging on to something because it collects theta, terrible thought process. The next thing you're going to start thinking is, I should sell really far out of the money strangles because they almost always win. And then you're going to be thinking that edge relates to win percentage. Yeah. And at that point, you're just completely tied up in knots and you're never going to get anywhere.
Yeah, no, fully agree with that. That was a great conversation. Thank you very much, Euan, for spending an hour with us. We can't find you on Twitter these days, so where can we interact with you?
I mean, technically I'm on LinkedIn, but I only go there like once a week. I don't know, probably the best way is coming through your Discord. I'll probably, eventually see something there if someone mentions me.
Yeah, no problem. Okay, well, thank you very much. Have a nice evening, and then speak to you soon.
All right. Thanks a lot, Alex.
See you. Bye-bye.